Hello again, everyone. Welcome back. In this technical analysis of the stock market video, I call it, is 8 really enough? And I think that's a question everyone needs to ask themselves as we think about the stock market. You know, these 8 mega cap big tech stocks have basically accounted for all or almost all of the S&P 500 gains in the 5.5 months this year. And is that really what's going to drive a bull market? Is that really something that's going to continue? Now, maybe it's going to morph into something else. We'll see. I've got my doubts, but that should probably not surprise you. Today, we're going to focus on the S&P 500, and then we're going to look at a couple of other things. I'm going to look at the put-to-call ratio, the equity put-to-call ratio that I've got. We're going to take a look at the high-yield bond fund. We're going to check in on the dollar, the Bloomberg Commodity Index, and oil. All right, let's start off here with the side-by-side view. And by the way, before I forget it, there won't be a video next weekend because I'm going to be traveling and no video. And happy Father's Day to all the fathers out there. I hope you have a wonderful day today. Okay. Today, let me see, we got the Dow Industrials, the S&P 500, and the NASDAQ 100. The Dow was up 422 points. So, you know, intra-week high, we came very, very close to taking out that December 13th intra-day high. And I think there's probably a pretty good chance we're going to continue to push up here and take that out. So I am moving to the alternate count that I've got on the Dow Industrials, which means I'm looking for a little more push to the upside. We'll talk about that on the S&P. The S&P was up 111 points, and you can see the counter trend rally that's been in place here. And of course, the NASDAQ, which has been, acting like a rocket ship blasting off here with the moves that's happened here in the last 5.5 months. It was up 555 points on the NASDAQ 100. So that is the counter trend move there. One of the things, let me show you first the Dow Industrials versus the transports. So here's the picture. Actually, this last week, I don't have an ETF. When I look at the ETF dashboard, there's no ETF index for the Dow transports, but I do use IYT. And IYT was the biggest percentage gainer of all the indices that I look at, the major ones. Okay, so that's pretty interesting. For 6 weeks, we traded within the trading range here of the week of April 23rd, but then now we pushed higher and broke out of that range that we've been in for 6 weeks. So now I'm watching this. Are we getting some little head and shoulders consolidation pattern? That's the question right here, because this hasn't formed yet. Yeah, I need lower highs, need it to come back down like this. I need that to happen, but that's going to be interesting that this could be a head and shoulders consolidation pattern. There's head and shoulders reversals and head and shoulders consolidation. This could very well be a consolidation pattern. We'll see what we get in here. So it's still a question mark, but that's on my radar. So we'll be watching that. Okay, now I'm going to show you, here's the chart of what I'm calling the FOMO 8, okay? Everybody's piled into these 8 big cap mega cap stocks. Easy for me to say. And I would say of the 8, the 3 big outperformers have been Apple, which has edged to a new high, Nvidia, which has definitely punched a new high, and then Microsoft, which is right up here. I think it may have also punched a new high in here. But the others are just in the classic little zigzag corrective pattern. And a couple of these, like Meta and Netflix, actually got below. The red line is the March 2020 low. Okay, so Netflix and Meta, both of them got below the March 2020 low. Amazon came down and tagged it, but then has bounced off of it. So now I think the thing that I'm really wary of, I know I've talked about with NVIDIA, that this could possibly be a bull trap in here, that it's doing a large what we call a corrective pattern called a flat. And in a flat, you get an A wave, a B wave, and then you get a devastating C wave that comes down. And the B wave can go beyond the beginning of the A wave, okay? And it forms somewhat of a bull trap. And I think the same thing may be developing on Apple and on Microsoft. Okay, so that's pretty interesting. And again, all these 8 have accounted for everything that we've gotten on the S&P 500. All right, so let's go take a look at the S&P 500. Let me go back to the home screen. So the SPX was down 16 points on Friday. All of the indices had this kind of look to them on Friday. And here's the picture again for the week, up 111 points when you round it. Now, my primary Elliott Wave count is this. I've got it labeled as a leading diagonal pattern that ended in October, an expanding leading diagonal pattern with a double zigzag corrective move that's going on for wave 2 in here. And this is what I mean by a double zigzag, this WXY, where we got a zigzag combined with a zigzag. And that's the problem with corrective patterns. I mean, you think you're getting a simple little zigzag and then that should be it. And then it morphs into something more complex. And sometimes you get, like when you get into fourth wave, sometimes you can get a flat followed by a zigzag, or the reverse, or a triangle. So yeah, it can become kind of messy. And this has stretched a lot further than I think anyone expected it to. So now where are we here on the S&P? Now, I'm going to tell you, before I spend a whole lot of time on here, I do want to mention that there's an alternate count. Now, the alternate count that I've got is just the same exact one that I've got on the Dow Industrials. And the alternate count says that, well, instead of an expanding leading diagonal pattern, that we had a contracting leading diagonal pattern that ended in June. And that since June, we had a 3-wave and then another 5-wave for C. So we've had this A, 5-wave, 3-wave, and the 5-wave for a zigzag for a 3-wave primary wave A. Okay, so 3 waves, not 5. Okay, you could count this either way. And now it looks like we're getting another 3 waves. So if you get a 3-wave, and then we get another 3-wave, we are in the throes of a flat. Now, for a B wave of a flat, I'm not going to get into a whole lot more detail, but for this to be valid, it has to retrace at least 90% of the A wave. So this has to go as far as 4685.92. Let's just say 4686. It's got to go to 4686, or this isn't a valid scenario that's playing out. So back to the primary count. If we get to where we punch just a little bit higher and then we flip, then this is the count we're staying with, okay? And when we look at where we are, yeah, we've had a deep retracement in here. We're well above 61.8% of 2 versus 1. We're approaching the 78.6%. Now, when I look at C versus A, this zigzag here within the Y pattern, it's rapid. It's getting very, very close to where C equals A. Okay, 44.82. I'm counting this as a B wave right in here because of the fact that this is a little 3-wave move. Okay. So that's why this looks to me like, it looks like a little running flat is what it looks like. And then we got this big, strong move up here for C. And when you look at the channel that we've got as a part of this zigzag, we're approaching the high of it also. So watching very closely for the price action to roll over and start to break down. We're deeply overbought. And yeah, it's pretty high on I have a 10-day RSI that I use, okay? And on 10-bar RSI, we hit 81.5 on Thursday. So yeah, it's at a deep retracement level, watching for this thing to roll over and break down. Okay, so that's the Elliott Wave picture I've got. Let's see. I wanted to look at something else here. Well, let's take a look at the high yield bond fund. Okay, so we've got all of that going on. Now, I don't have a wave count. I'm not worrying about the wave count on HYG. Okay, so here's the weekly. Now, I think the key thing, we often look at the high yield bond fund and say, okay, it's either risk on or risk off is what it's telling us. Well, this is not confirming anything that's going on in the S&P 500. Okay, here's, excuse me, here's the August high. Here's the February 2nd high, or the end of January high on the on HYG. Okay, we did not take out the August high. We haven't even taken out now the February 2nd high, as the S&P has continued to punch higher in here. The February 2nd high didn't take out the August. We took that out here just recently, but we're not even close. We're just not confirming this at all. So this continues to have a risk-off type of picture, very weak counter trend, which again makes this, it's just suspicious in terms of the underpinnings as to what's going on. And of course, I already talked about, how the breadth of the market is extremely weak in terms of what's going on, in terms of the move that's happening in the S&P. All right, I wanted to take a look at the equity put to call ratio. Now, what are we getting? On Friday, 44 puts for every 100 calls. When it gets down below 0.45, I start coloring it a deep, dark blood red, okay? And when it gets below 5.5, I start coloring it yellow as a cautionary. It's a 10-day. The 10-day moving average of equity put to call only, okay? So we haven't seen these kind of readings. Now, granted, I'm just getting this now, since the March high of last year. So we're not getting extremely bearish. Okay, back here, yep, the sentiment turned really bearish in November going into December. It turned extremely bearish. We started getting all these extremely bearish one-day readings every week. And it was just a weird scenario that happened. And now we're starting to get the opposite extreme. Okay, so we'll see how much longer do we get this? Do we get several days of this? But right now, that's where we sit. The sentiment is changing. And of course, everybody's watching the VIX too. We know, we've broken, we're down to levels that we haven't seen on the VIX since January of 2020, weeks before the major peak or right about at the peak in 2020. Okay, so that is the picture there. High yield bond fund, put to call ratio. Let's take a look at the dollar. Okay, the US dollar index was up 0.128 on Friday. A little bit of a bounce back after a big downdraft for 3 days in a row. And for the week, down 1.314. Okay, so big move. The count I've got is this. And, for the longest time, we're sitting here going, okay, are we a part of an impulsive wave for, this ABC corrective pattern in here? Are we continuing to impulse lower, or are we doing something more like this? Have we got some like flat developing for the B wave? Again, a B wave and a zigzag, a B wave can be any corrective pattern, okay? So right now, we kept looking at this and it said, is it this or is it this? And with the price action that happened this last week, I believe that this is exactly what's going on. So what does this imply? Look, the dollar's going lower. Now, we don't know, is this C wave going to turn into an ending diagonal pattern or an impulse? But the way it started off with wave one, it just looks like it's going to be an impulse, because in an ending diagonal, each wave needs to be a zigzag, and that wasn't a zigzag to me. So I'm leaning into the impulse pattern, which implies we got more to go and should be somewhat strong as we pull back down in here to complete primary wave 2 of the US dollar. Okay, so that's the picture I've got on that. So look what's happening over here on the Bloomberg Commodity Index. And let me just go right here because this is where I look at it. This is a weekly view. Look at the move that happened this last week on the Bloomberg Commodity Index, up 4.18. This dash line I have had for months, this support line for months, showing this to my members every week. Okay, so we were channeling down. I had drawn this channel, and we never got to the bottom of the channel, but we got very close to that support level, which was 96, and the low of that week was 97.01. And look how we basically have just launched off of that. So this looks kind of interesting, and it could be a sign that oil is getting ready to go higher and other commodities too. We'll see. Take a look at oil in here. Here is the pattern. Let's just take a look at the price action first. That was not my Elliott Wave count. That was an alternate scenario that I was toying around with. So here's what happened with oil. Up 43 cents on Friday, USL, which is the United States 12-month oil, and up 74 cents for the week. So this has been a very messy pattern here over the last several weeks, ever since this low here on May 4th. And so now, I mean, it had every chance to just, fall right through the floor, and it really hasn't done it. So we'll see where, the jury's still a little bit out on this. I'm looking for this to take out this high. Here's the count I've got. I'm looking at this thinking, okay, cycle wave 2 bottomed here in March, and I think we are up with 1, 2, and within now we're doing a third impulsive wave to the upside, but we need to get going. Okay, so right now I'm thinking that we've got a 1, 2 like this, okay, but we need to take out this high right here, 33.57, and West Texas Intermediate closed the week at $71.61. So that's the picture I've got on oil. We'll see if we continue to get it to thrust higher, and the U.S. dollar may affect a whole heck of a lot of other things if it continues to go right through the floor. Okay, that's it for this weekend. And again, remember no videos next weekend. If you felt like this video was helpful, give it a thumbs up. If you're not a subscriber to the channel, hit that little subscriber button. And if you'd like more of this information on a regular basis, head over to joehenches.net. Check out the website, check out the membership. Everyone have a great week. And again, happy Father's Day to all the fathers out there.